Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week ending February 17th. Pretty bullish price action in the cryptocurrency space, but a lot of sideways price action in the market, so let's dive into the charts and take a look at what we're seeing. Starting out with Bitcoin. Bitcoin had a big move on February 15th to the upside, broke back outside of this descending wedge, and now contending with his anchor VWAP position at about 25,000. Looks pretty bullish to me, and as long as we start to see price action break up above that 25,000 level, then looks to me like we're heading higher and going to be testing that $30,000 level, which would be the next area of resistance to watch for. And then if we get above those levels, the ultimate wave 3 top that I'm looking for on Bitcoin is sitting at about 35,700, and that would likely complete our wave 3 to the upside on Bitcoin. So things are looking pretty good in the cryptocurrency space. Jumping over the Ethereum chart, also looking constructively bullish, looking for our next area of resistance around 1900 or so on Ethereum. As long as Bitcoin continues to head higher, I'd expect Ethereum to follow suit. And then taking a look at our total cryptocurrency market cap, we are back up above 1 trillion, which is good to see for the crypto bulls. And looks like our next area of resistance to the upside is between about 1.2 and 1.25 trillion, which is a couple of anchored VWAP levels in the cryptocurrency space. But things are looking pretty nice for the cryptocurrency sector at the moment. Jumping over to the S&P 500, a little bit more sideways to downward price action in the traditional markets, but we did ultimately put in a bit of a hammer candlestick and find some support at this trend line. So as long as we're holding that level, I think there's a good chance that we rebound from here. And even if we did break down a bit, as long as we're staying above this 390, 395 level on the SPY, I think we still can be more long-term bullish for the markets. So we could potentially break down a little bit further from here and still kind of have a longer term view to be bullish for the markets. And there's a decent chance that this might have put a low in on Friday, and maybe we rally going into next week. We do have President's Day holiday on Monday, so we'll need to wait till Tuesday to ultimately see how this starts to resolve. But I think there's a pretty good chance that the markets will ultimately hold up, even if we see a little bit of a breakdown from here, and still looking for overall bullish price action going forward in the coming weeks. Taking a look at the S&P 500 breadth, we're sitting at about 68% of our S&P 500 stocks above their 200-day moving average and about 65% above their 50-day moving average. So we have seen a little bit of decreases there. We haven't seen any major breakdowns in our breadth measures, and so things are looking pretty well there. Jumping over the NASDAQ, triple Qs also putting in a bit of a hammer candlestick on to close the week out. Looks to me like we've got a bit of a corrective phase with a Elliott Wave 4 to the downside. That could be completing potentially, and if we see that rally from here, as long as that 297 level is holding, then we'd be looking for an upside target of about 323 on the triple Qs. We could potentially correct a little bit lower. If we did, we'd be looking at some levels around 293 or 289 on the triple Qs if we do see a deeper correction on this wave 4. And so as long as we're holding at least this 289 level on the triple Qs, I think we can still stay bullish longer term and looking for the next leg higher. But if we do see a breakdown below that 289 or so level, then I think I'd start to question whether or not this is a bigger breakdown in the markets on the NASDAQ. Jumping over the breadth measures for the triple Qs, we're seeing about 68% of the NASDAQ above their 200-day moving average and 72% above their 50-day moving average. So things are looking pretty good shape for our breadth measures as well. As long as we're not breaking down kind of below this 60% level on either one of these, then I think that's looking pretty constructively bullish, and that we're likely just seeing a bit of a corrective phase before we ultimately head higher from here. Take a look at the Dow Jones Industrial Averages now. We're still sitting in this bull pennant here. While we have seen some pretty choppy price action in the Dow Jones Industrial Average, we are still kind of staying nice and tight in this bull pennant here. So as long as we're holding support above this descending trend line here, this lower trend line here, still looking for ultimately a resolution to the upside on this. We have broke up above this Fibonacci extension level as well at 343 on the DIA a couple of times, but had a pretty quick failure off those levels. So looking to see if we can ultimately get price action back above 343 on the DIA, and if we can see a couple of daily closes above those levels and start to see that hold the support, then I think that would probably be a pretty strong signal that we're likely heading higher more broadly in the markets as well. Transports are also looking good. We had a big move back in late January, early February in the transports. Now it looks like we're putting in a bit of a consolidation pattern, but it's looking pretty tight as long as we're holding above that 15,000 level. And I think this just looks like a bit of a corrective phase with the bull pennant or bull flag going on right now. And once we get above this 15,300 level, would expect that the transports will likely head higher from here. Take a look at our Russell 3000, also looking pretty strong here. We've had about a month now of weekly closes of price action above the 50-week moving average, and we also broke outside of this descending trend line, and so things are looking decent here. Wouldn't surprise me if we potentially broke down and retested the 50-week moving average a little bit. If that occurs, as long as that holds, I think that's still fine. Or we might ultimately see a resolution a little quicker and just see a break up above this trend line to the upside. We do have the center channel to contend with, which is kind of where we peaked out previously about 3 weeks ago. We can see price action get above that center channel line in the Russell 3000, then I think that's a really bullish signal for the markets, and we'll likely see some much higher prices in the markets come in the fairly near term. And then taking a look at some of our New York Stock Exchange new highs and new lows list, we can see that on our new highs list, we still have quite a few stocks putting in new highs. However, those trends are declining in the month of February. But I think as long as that doesn't continue to break down further, this still looks fairly decent, and we're also not seeing any major new lows being put in. So as long as the new lows kind of stay at these low levels that they're at, and the new highs don't completely break down, I would be looking for these new highs to start to head back to the upside. And if we get that move to the upside with our new highs, then I think that'll probably correlate with price action ultimately breaking out and seeing some next legs higher in the market. Russell 1000 for our large caps, similar to the Russell 3000 chart, broke out of that descending wedge, got above our 50-week moving average, and now it's just been consolidating for about the last 3 weeks. So we want to see price action get up above 231 or so, and if we see that happen, then it will be a pretty bullish sign for our large caps. And then looking at our small caps, those are already looking pretty strong here as we've ultimately held up support on this trend line and also got back up above this 191 level on the IWM, and we also got up above our anchored VWAP on Friday, which is this is an anchored VWAP from our previous all-time highs in the IWM. So as long as we are holding price action above that, pretty hard to be bearish in small caps, and I think we're likely headed higher from here. And then taking a look at our bond markets, taking a look at the top panel here, we've got our TLT, and then on our bottom panel here, we've got our IEF, which is our 7 to 10 year bond. Both of them had a pretty strong move on Friday, and we'll get into the interest rate charts here shortly to show kind of why I think that's going to continue. But it looks to me like we've got a good entry point here on both the TLT and the IEF here. As long as the IEF is holding above this 95.60 level, then I think this is a great entry point, and we can trade this with that 95.60 as our support floor. And then looking at the TLT here, we've got this trend line here where we've now had 3 touches, and as long as we're holding up above those levels, I think that's a great level to trade off of and go long on our bonds as well. Take a look at growth versus value. Growth is still continuing to look pretty strong over value, and each time we've seen a strong growth rally over value, that's been a pretty good tradable space in the market, even during last year when we had some pretty tough conditions in the market. And so we're continuing to see growth outperform value, which is looking pretty good, and unless we see a major breakdown there, I think that's also another reason to stay constructively bullish. And then jumping over to our sectors that we tracked over the last 5 trading days. So for the last week here, we saw our sector leaders were a couple of the ARK Innovation funds. We had the FinTech as well as their flagship fund, both doing 7% and over 4% in upside in just a week. So also not something you would likely see in a space where the markets are completely breaking down. I don't think we would see ARK Innovation ETFs being in the leaderboard for the week. So I think that's also pretty bullish for the market. Also saw some strength out of retail, autonomous tech and robotics up over 3% each. Steel is up over 3% as well. And then we also saw cannabis up over 2.5%. So cannabis is another sector where it's very much a risk-on type sector. Generally, you're not going to see cannabis stocks move to the upside when the markets are falling apart. So I think some of these sectors at the leaderboard are also looking pretty bullish for the overall market. And then take a look at our worst performers on the week. Natural gas broke down ultimately once again. We lost support. I think it was at about 820 or so on the UNG. That was a major floor. It was the previous lows on the UNG, and so we've broken down from there now. And so I'm actually took a small loss on my natural gas trade to the upside, and since that did hold support, I'm actually now shorting that, because it does look like to me there's potentially maybe another 20% or more of downside here. That 20% downside target is the 10-year logarithmic regression channel, and if you look at that chart, there's actually a couple of times where we did ultimately get down to that 10-year log channel to the downside, and so it looks to me like that might be the next and final leg lower on natural gas. And while it certainly could blow down below those levels, would be very unlikely, and I think that'll be the next area of support I'll be watching for to potentially look for a long trade on that once again, but still looking pretty bearish for natural gas. Also seeing the energy space getting beat up pretty bad. XOP is down over 7% on the week, energy is down over 6% on the week, and so those sectors are looking to correct right now. We'll be looking to see if the XLE can hold the 200-day moving average as support. And if we see it hold support there, that might be an opportunity to get long again on the energy trade. But for now, watching that correction and seeing where we can find support before we look to re-enter some of the energy trades. And then also seeing GDX down on the week over 4%, but we'll get to the GDX chart in a little bit. I think both based on interest rates and this GDX chart, it's actually looking like a great entry point for our gold miners. Also seeing some weakness out of lithium, down over 3% on the week. Global markets are down below their 200-week moving average. We failed off of that 54.86 area of resistance, and then also got down below our 200-week. So as long as we're below those levels, I think we have to be either neutral to bearish on that. But if we can ultimately see price action recover and get back up above the 200-week moving average and this 54.86, then our next upside target on the VE would be closer to about 59 or so. Oil markets are down on the week, down about 676.50 per barrel. Just a lot of sideways price action. We keep resisting on this 21-week EMA, and so as long as that continues, then I think we have to be either neutral to bearish on oil prices and potentially still looking for a test of this 200-week moving average, which is about 66 per barrel right now. But if we see price action break up above that 21-week SMA and ultimately hold that, then that could be the signal that oil is potentially breaking out, and that would be if that does occur, I'd be looking to likely re-enter some energy trades at that point. But until we see that, I think we need to be patient on the energy space right now. Commodities are down a bit on the week, still sitting above some key area of support though. Really want to see CRB index break down below 265 if we want to get bearish on it, as we've just kind of seen a lot of sideways chop in the CRB index, and also not seeing it being able to get above our 21-week EMA, which is currently at about 280 or so. So we want to see a break above 280 to get constructively bullish on the CRB index. And then jumping over to our precious metals, gold looks like it might have put a bottom in. We hit the 61%, 6.618 retracement level on Friday, and then we had a pretty big move to the upside. However, we do have this anchored VWAP to contend with. It's just slightly above it, just below 172. So if we can see gold get back up above 172 on the GLD, then I'd be looking to potentially enter a long trade. And it looks to me like we got one leg higher on this wave 3 to the upside, so I'd be looking for about a 186, 187 price target on the GLD to the upside. But I want to see price action close above that 172 anchored VWAP level first before I get a little more confident that the correction is over and that we'll likely be heading higher in gold. But I think there's a pretty strong chance that 618 retracement level is ultimately going to hold as support. And then taking a look at the silver chart, SLV also put a pretty big move to the upside, got back up above 20 to close the week out, but we still are kind of in this descending trend line here, and so I want to see a breakout above that trend line, and otherwise potentially we might see it roll over next week and potentially head lower. If we do head lower, looking for that 1935 level on our 200-day SMA, or our 0.618 retracement level at about 19 or so on the SLV as areas of support if we do continue to head lower. Otherwise, we'll be looking for a potential breakout if we want to trade this to the upside. And then interest rates. 2 years are sitting at about 4.6%. We are at the top end of this trend channel line. We've been kind of slowly but surely heading a bit lower. Obviously, these last couple of weeks we had a pretty big move back up to the upside. That kind of came in with the hot jobs report and some stronger economic numbers than I think the Fed was expecting, and so I think the markets are now starting to believe that we're going to have higher interest rates for longer, and that ultimately kind of spiked up our rates a bit. But I do think it got a bit overdone, and we're likely going to be rolling over from here. And so unless we see that trend line break to the upside, I'm looking for really all of our interest rates to roll over from here and head lower, which is one reason that's I think supportive of re-entering some gold and precious metals trades, because typically when our 10-year rate is heading lower, the gold prices are heading higher, and we'll get to that with the GDX chart here in a little bit. But taking a look at our 10-year first, we got up to the top end of this channel now. We've got 3 solid areas of resistance now on this trend line. And so as long as that doesn't break to the upside, I think the most likely outcome is that we'll head lower on the 10-year. And if that does occur, that's going to set us up for both some bond trades as well as some gold and precious metal trades. And then taking a look at the 30-year, similar story, three touches on the trend line, sitting at about 3.87%. And I think the most likely outcome on this is to head lower as well. Jump over the dollar chart, the DXY did see some bullish price action out of our DXY this week. Looked like it was potentially breaking out of this bull flag. If that did occur, which it did slightly, we'd potentially be looking for it to maybe go get back up and retest this 200-day moving average at about 106 or so. We'll see how that resolves next week. It had a pretty big move on Friday, but then ultimately gave up all those gains and then retested this 103.80 level. So we'll kind of see how it shakes out next week. It could find support there and ultimately still head higher and retest that 106 level. If that happens, then we'll likely probably see some more choppy price action in the markets or potentially head lower. But if we do see the DXY break down and correct from here, then I think that'd be pretty bullish for the stock market. Then jumping over to the HYG chart, our high yield corporate bond ETF. This is a strong indicator chart for me for evaluating the overall health of the market. Typically when HYG is going down, the markets are following. And as we can see here, we put in a bottom in HYG in early October, and that correlates pretty nicely with the bottom that we put in the S&P 500, and ultimately stocks started heading higher from there. So as long as we're holding this trendline support level, then I think we can stay bullish both in HYG as well as the stock market. And so far we came down on that and tested that Friday pretty nicely and then bounced back up off those levels pretty good. So as long as that ultimately is holding support, then I think we can still stay constructively bullish for the markets. And then we've got our investment grade corporate bond ETF. Let me pull that up here. So this is our investment grade corporate bond ETF divided by our IEF, our 7 to 10 year bond rate, and this is a pretty strong market health indicator as well. So this white line here is actually our quarterly EMA, so it's a 13-week exponential moving average, and if you watch that white line, you can kind of see that typically when this ratio chart is heading lower, the stock market's heading lower. When it's going higher, the stock market's heading higher, but this 13-week EMA is also a pretty nice indicator line. As typically when we are above that level, the markets are looking pretty strong. We can see that when we broke up above that 15-week EMA on this ratio chart, it was towards the end of October, which was pretty close to when we had put in our bottom and ultimately started to see the market rally. And so if you kind of traded off of that 13-week EMA off this ratio chart, gave you a pretty strong signal that the markets were heading higher, and they've ultimately held that as support so far. We did come down and test that on Friday, but it ultimately held support and then bounced up. So that'll be something I'm watching going into next week. If we can see that hold as support and we ultimately see this chart head higher, then I think that'd be a pretty strong signal for the markets as well. And then take a look at our put call ratio. They're in fairly normalized levels. Anything above 1 is elevated put line protection, and we stayed below that all week this week, sitting at about 0.87 to close the week out. And so as long as we're below this 1 level and not seeing any major spikes there, then we're not seeing any massive put line protection, and I think seeing an overall kind of constructively bullish setup for the markets as well. And then jumping over to our VIX. VIX is also not really spiking a bit. While it has had a few spikes recently, it really hasn't been able to do any major jumps up above 20, and every time it has, it's really come quickly back down to the 20 level, if not lower. And so as long as we're not seeing a big spike up to 25 or higher, then I think that's also a pretty good sign for our markets. We'll go ahead and wrap it up with this GDX trade that I talked about. So the gold miner ETF here that we're looking at the top panel, and the bottom panel we're looking at our 10-year bond. And so, as I mentioned before, typically we can see really easily on this chart when the 10-year starts to roll over, the GDX starts to head higher, and it's similar for gold as well. But the gold miners tend to give you a lot more upside than trading the actual precious metal. So I like to trade the gold miners, and you could even go a little bit more leveraged and trade something like GDXU, which is a 3x bullish ETF for the gold miners, which gives you even more upside opportunity to trade off of. But this is a great looking chart to me here. We can see that each time we peaked out on the 10-year on this bottom channel here was a great time to essentially enter some long positions in the GDX. And so the last time we bottomed out here back in November 3rd, we were just peaking on our rates, and then ultimately the GDX headed quite a bit higher from there. If you bought that bottom there and then ultimately just waited for a major rollover even to that first level, you made about 35% in 30 days. And so that was a nice trade setup there, and it looks to me like we are once again at this trade setup as we're down at this bottom channel here. We've got the top end of the range on our 10-year bond, and then we also are finding support above our 200-day moving average. So all of that looks like a lot of really great technical setups to trade off of, as long as we're holding that bottom channel on the GDX and the 200-day moving average. This seems like an absolute no-brainer to go long on the GDX, and as long as we're not seeing the 10-year shoot higher and we're seeing the GDX hold above that 200-day, then I think this is an excellent trade setup for the gold miner space, as well as potentially putting some longs on in some actual gold miner stocks or the actual precious metals as well. So thanks for tuning in, and make sure to download the ToroAlerts app on the App Store. We've got one for stocks and one for crypto, and you can check us out at ToroAlerts.com.